Hello and welcome back to Technical Analysis 101, where we are slowly taking off my technical analysis learner plates, helped along by our senior market analyst, Daniela Hathorn. What are you going to teach me today?
So we're going in with Bollinger Bands.
Bollinger Bands.
Yeah.
Bollinger is a champagne?
Yes, I wish.
No?
It sounds very exotic. It's just the name of the guy who invented them.
Okay, cool.
Bollinger Bands.
So he invented champagne and chart indicators.
Yeah,
Good
he
to
was
know.
a very exciting man.
Cool.
So Bollinger Bands, we're bringing in some of the stuff that we've already learned. So do you remember the first time we did this, we were talking about moving averages?
Yeah.
Right, we're bringing them back to some extent.
Okay.
So essentially, Bollinger Bands is more a measure of volatility, which is the speed of change in price, which is a key metric in markets. And Bollinger Bands try to measure the momentum within that volatility. So essentially, the way it's calculated is you take a 20-day simple moving average, which you know by now what it is.
Yep.
So you take that moving average, which is a line on the chart, and you create two bands that track that line at a standard deviation away either side.
Okay.
So a standard deviation is a mathematical calculation, very used in statistics, and it just measures the deviation of price from a certain range. So essentially, as we'll see on the chart, the Bollinger Band is a moving average followed by two bands that are tracking and they're getting further apart or closer together. So that is what Bollinger Bands are.
It sounds like I'm going to need to see it on the chart. So
Yep.
should we dive into the chart and I can actually see what it looks like?
Yep, here we are on the chart.
Okay, yeah.
As you can see, as I was telling you, that moving average is this orange line here, and your standard deviations from the top and also the bottom are these blue lines here. So see, they're creating kind of like this wave pattern, right? And it's tracking the moving average. So essentially, as I said, moving average is a measure of volatility.
Yeah.
And the first way to read this is the closer the bands are together, like here, it's called a squeeze. Essentially, it means that the bands are squeezing the moving average. And that is telling you that it is a period of low volatility, and therefore we could see an increase of volatility coming from that.
Yeah.
The opposite is when the bands are very far apart. It tells us there's a lot of volatility in the market at the moment, and therefore we could expect that volatility to reduce and the bands to tighten. So as I said, the Bollinger Band is mostly a measure of volatility. So the more volatility there is, the wider the bands will be from each other. So that is one of the ways to interpret this. One of the things I want to say is that Bollinger Bands should always be used in correlation with other moving averages, because it's not so much an indicator of price. So it's not so easy to determine reversals and opportunities like other indicators, but it measures more volatility, and therefore that can confirm whether a trend is coming to the end, or we're seeing suddenly more interest in an asset, and therefore we could see a reversal coming. So one of the things that happens is that a lot of people misinterpret the bands, thinking that, okay, if we've got a breakout above the band, that means we're going to see a reversal. We've broken the band, that means it's an overbought asset, we're going to reverse lower. And that is not really what the Bollinger Bands are trying to tell us. They're not trying to tell us a price reversal is happening. They're telling us, okay, volatility is quite tight here, as you can see, because they're quite close to the moving average there, and price is starting to hit the upper bound of this. So we could expect that to widen, because it seems like price is constrained within that tight range. So as I said, it's always best to use it in correlation with other assets like the RSI or other moving averages.
Okay, that makes sense. And what sort of kind of trading style is this suited to? Again, is it the kind of longer term positions? Is it day trading, short term positions? What style is it suited towards?
Yeah, I could say it's definitely for long term. I think, again, with everything you can adapt it. And if you go, we're on a daily chart now. If you go to, for example, a 1 hour chart, you're still going to have the bands there. So essentially, they're now telling you the picture within a 1 hour chart. But it can be a little bit more. It can be a bit harder to interpret. And I think one of the problems with Bollinger Bands and one of the issues is that it has more false signals than it has actual reversals or breakouts, because of what I'm saying, that just because we have the price touching one of the bands doesn't necessarily mean it's going to reverse. It's more telling us that, volatility might increase. So you can adapt it to whatever style you want, but with anything, hindsight is, very easy. It's very easy to see things in hindsight. And if you're looking like the most recent data here, sometimes it can be a little bit harder to interpret what it's telling us in that precise moment. So maybe for day trading or intraday trading, it's a little bit harder because most indicators do have lagging data. I mean, it's using a moving average. So essentially, we've got the same issue with moving averages. It's using data that is slightly lagged, and therefore a reversal might have happened, or a change in volatility might have happened by the time we realized on the chart. So I would say probably more for longer term trading than shorter.
Yeah, I mean, looking at where it is kind of at the moment, what would you say is a good way to kind of read what's happening in the market at this present moment?
Yeah, so you can, for example, you can tell that the bands have started to shorten a little bit or get closer together, so they're starting to squeeze the moving average. So that is essentially potentially showing, okay, well, we're seeing volatility reduced. Again, in isolation, it's quite hard to read exactly what it means. If you were looking, for example, at volume, which volume measures the amount of trading going on, and you're seeing volumes decreasing and the bands are getting shorter. Okay, well, we're losing interest in this asset. We have less momentum from new traders coming in. You can look at it, for example, with the RSI. Maybe the RSI is showing overbought or oversold conditions, and this isn't giving you that feeling. We haven't really seen a change in the bands. We've seen price really tracking that 20-day moving average without moving towards the other areas of the band. So we're not, even though the RSI is pointing to a change in trend, you don't think that the Bollinger is signaling just yet. So I think, as I said, it's quite a hard one to read in isolation. I think you always need to pair it with something else.
Once again, it's kind of similar to the RSI and the moving average in that you can't look at them all as just one thing. They all kind of feed into each other to kind of form your basis of where you think the market's going to go.
Yeah, indeed. And I think one of the great ways to do technical analysis is to use these indicators in combination, 2, 3, maybe even 4 of the ones that you're most comfortable with. And it's more, you have to view markets as telling you a story. Are they all moving in unison? Is that a clear sign that we're going to see a reverse, whether it's a reversal, whether it's a price change, whether it's whatever they're telling you, that when you use them in combination, you see the strength of that conviction. And I think, as I said, the Bollinger Bands are quite different from the moving averages and the RSIs because they measure something slightly different. Up until now, we haven't talked about volatility. We've talked about momentum and the strength of a trend. Whereas here, we're also looking at the strength of a trend, but how does volatility fit into that? And, do we have these bands widening and getting closer together? And what exactly does that tell us? And how can we read that in combination with momentum indicators?
So let's say we had the RSI and the momentum was moving towards kind of overbought, but the volatility was still quite low. What would that tell you? What movement what would you be kind of looking at in terms of where the market was going to go?
I feel like, especially when you have a change in trend, you usually see volatility increase, you see interest increase. And I think if you've got Bollinger Bands that are quite close together and you're starting to see a change in momentum in the RSI, you're likely going to want to start to see that price starting to challenge one of the bands, especially the top band here. So if you've got, for example, price starting to push against the band as you have here, and you're starting to see in the RSI, you've got overbought conditions, expecting a reversal to happen soon, you're really seeing that the price is now starting to feel constrained within these bands. So essentially, you're expecting that reversal to see volatility come. And that's exactly what's happened here. So we've started to see the price really challenge the upper band of these Bollinger Bands. Buyers are starting to kind of not feel comfortable within this volatility spectrum. We've started to see these bands widen, and then when we do get that reversal, we see those bands really kind of taking that wider stance. So again, it's just, is the Bollinger Band giving me the kind of scenario that I need for this reversal to happen?
Would you mind putting the RSI on the chart here, actually, just so you can kind of see the correlation between the two?
Yeah, again, one of the issues is with most indicators, a lot of times you get false signals.
Yeah.
And the RSI and the Bollinger Bands are both known to do that. But for example, here you do actually have, you're starting to see the RSI breaking above that 70. It hovers there for a while. And that's when we're seeing the price here starting to pressure the upper band of this Bollinger Band. And then we see that the period of price starting to reverse, and then the bands get wide, and that's when we see that sell-off coming in. So, as I said, it's all about reading them together, and sometimes you'll have this breakout and the price threatening to break the Bollinger Band, and then we don't actually see that reversal happen. And that is one of the key drawbacks of indicators, is that sometimes, you know, they're not hard to read, they're not easy to read, and they can give false signals. But for example, here, this is a prime example of how you would use these two in correlation.
That's really helps, and I can very much see how you can look at both and make a kind of informed decision on where you think the market's going to go. Are there any other kind of drawbacks to it? Is it similar to the other kind of indicators, that it's lagged data, and you know they're not always guaranteed?
Yeah, I think that's, we've kind of gone over them. It's lagged data because it's using a moving average. It creates a lot of false signals, and also the misconception that sometimes people think that the Bollinger Bands are telling you a price reversal is going to happen, whereas that's not exactly what they're telling you. A lot of the time that it derives into that, but reading the Bollinger Bands doesn't tell you a price or a direction change is going to happen. It's telling you about volatility. It's telling you that the price is starting to feel constrained within those bands, and that could potentially lead to a change in reversal. But reading it in isolation, you could be misdirected by thinking just by touching the upper band we're going to reverse.
Well, thank you once again, Daniela. I think I fully actually do understand Bollinger Bands. Thank you for watching, and don't forget to like and subscribe, and we'll see you next time.